Deriv Studio Updater TATA Motors, the Indian automotive giant, and Jaguar Land Rover JLR, its prestigious British subsidiary, have recently come under the spotlight due to a series of operational, financial, and strategic challenges. The partnership, once hailed as a masterstroke that brought new life into two iconic brands, is now navigating turbulent waters. While TATA has a history of bold acquisitions, the Jaguar Land Rover deal, finalized in 2008 during the global economic crisis, stood out for its audacity. Fast forward more than a decade, the landscape has changed dramatically, raising questions about the sustainability and strategic direction of this alliance. Jaguar Land Rover, known globally for luxury, performance, and off-road prowess, has faced mounting pressure from various fronts. From declining sales in China, increasing regulatory burdens in Europe, to the global shift toward electric vehicles (EVs), JLR has struggled to keep pace with the industry's rapid transformation. The rise of new players like Tesla and Chinese EV manufacturers has only intensified competition, making it harder for legacy automakers to retain market share without radical innovation. For TATA Motors, JLR was not just an acquisition, it was a statement. It signified India's growing footprint in the global auto industry. Initially, the acquisition seemed like a match made in heaven. TATA's hands-off management allowed JLR to maintain its British identity, while providing the financial backing needed for ambitious product development. This led to the introduction of new models like the Range Rover Evoque, Jaguar F-Type, and new generation Land Rovers, all of which were well received in key markets. These moves paid off, with JLR contributing significantly to TATA Motors' revenue. However, the past few years have exposed deep-rooted vulnerabilities. The COVID-19 pandemic disrupted global supply chains, while the semiconductor crisis hit premium automakers especially hard. JLR, with its focus on high-end, tech-heavy vehicles, found itself in a chokehold. Production delays, component shortages, and logistics challenges compounded existing issues. Sales plummeted, inventories piled up, and profitability took a massive hit. TATA Motors was forced to inject capital to keep operations afloat, even as its own domestic business struggled to recover. At the heart of the issue is Jaguar's identity crisis. While Land Rover continues to enjoy robust demand in markets like the US and Middle East, Jaguar has lost its appeal. Once a symbol of British luxury, Jaguar now lags behind German rivals like BMW, Mercedes-Benz, and Audi. Critics argue that the brand lacks clear direction. Is it sporty, luxurious, or electric-forward? Conflicting design choices, product overlaps, and uneven pricing strategies have diluted the Jaguar brand. Unlike Land Rover, which has a loyal SUV fanbase, Jaguar's sedan lineup has been fading in relevance, with models like the Z and XF failing to make an impact. Adding to the turmoil, JLR has been plagued by quality and reliability issues. Reports of frequent breakdowns, electronic malfunctions, and poor after-sales service have dented consumer trust. The luxury car market is unforgiving. Buyers expect not just performance and prestige, but also dependability. Negative reviews, coupled with lower resale values, have made potential buyers wary. This is especially damaging in key markets like the United States, where German brands dominate and brand loyalty is hard to break. JLR's pivot to electrification has also been sluggish compared to rivals. While the Jaguar I-Pace was an early entrant into the luxury EV segment, its momentum was short-lived. Tesla's dominance, combined with newer EVs from BMW, Mercedes, and Audi, quickly overshadowed the I-Pace. The lack of follow-up electric models and an unclear roadmap for Jaguar's EV transition further fueled uncertainty. TATA Motors, through its electric division in India, has made significant strides in EV technology, but those learnings have yet to be effectively transferred to JLR's global operations. Amid this scenario, TATA Group has signaled a major reset. Chairman N. Chandrasekaran and CEO Thierry Bolloré laid out Reimagine, a bold vision to transform JLR into a fully electric, modern luxury brand by 2030. The plan aims to phase out combustion engines gradually, reimagine Jaguar as an all-electric marque, and overhaul manufacturing processes to reduce carbon footprint. While this vision is ambitious and future-forward, execution remains a colossal challenge. Developing new EV platforms, revamping production lines, and building charging ecosystems requires billions in investment and years of sustained effort. Furthermore, the global auto industry is entering an era of partnerships and platform sharing. TATA is exploring synergies between its Indian EV division and JLR to reduce R&D costs and accelerate development. This includes shared EV architecture, battery technology, and software integration. The goal is to unify innovation pipelines while maintaining brand distinction. Such moves could provide much-needed economies of scale, especially as both entities struggle with thinning margins. On the financial front, TATA Motors has shown resilience. Cost-cutting measures, debt reduction strategies, and better cash flow management have helped stabilize operations. JLR, too, has trimmed its workforce, optimized its supply chain, and refocused on profitable models. However, the shadow of massive R&D expenditure and the uncertain return on EV investments continues to loom large. Investors are cautiously optimistic, but patience is running thin. Geopolitical tensions have also played a role. The UK's post-Brexit trade uncertainties, changing emission norms, and regulatory volatility have added layers of complexity. For an export-heavy manufacturer like JLR, such instability directly impacts planning and profitability. Moreover, rising protectionism in markets like China and the US threatens to undermine global strategies. Localized production, tariffs, and tech regulations mean JLR must rethink its global footprint. Internally, morale has taken a hit. Employee layoffs, factory shutdowns, and restructuring announcements have created an atmosphere of unease. Cultural differences between Indian management and British workforce, though mostly managed well in the past, are starting to show signs of friction. Maintaining brand heritage while driving change is a delicate balance, one that requires transparent communication, long-term vision, and trust building. In contrast, TATA Motors' domestic business in India is witnessing a resurgence. Strong performance in the commercial vehicle segment, rising demand for Tata's electric cars like the Nexon EV, and strategic partnerships with companies like Uber for EV fleet deployment have revived its image. This contrast between the thriving Indian unit and the struggling JLR division has led to calls for operational autonomy and sharper strategic focus. Some analysts have even speculated about a potential spin-off or partial sale of Jaguar, while retaining Land Rover under the TATA umbrella. While TATA has denied such rumors, the idea of brand separation is gaining traction among industry watchers. If Jaguar's reinvention continues to falter, divesting or partnering with another player might be the only viable option to preserve value. As the world transitions to sustainability, digitalization, and autonomy, automakers must evolve or perish. TATA Motors understands this reality. Its success with TATA Technologies, a software and engineering services arm, provides a template for JLR's digital future. Infusing Jaguar Land Rover with advanced driver assistance systems, ADAS over-the-air updates, and AI-powered diagnostics could redefine the ownership experience. But these innovations require a tech-first mindset, a shift that JLR is still coming to terms with. Customer engagement is another crucial area. In the age of social media, brand perception can change overnight. JLR needs to double down on customer service, community building, and influencer partnerships to rebuild brand equity. Initiatives like exclusive owner clubs, immersive brand experiences, and personalized concierge services could re-establish its luxury appeal. TATA Motors has the marketing muscle and customer insight from the Indian market, but adapting those strategies globally requires localization and nuance. At the macro level, the TATA JLR story is a microcosm of global automotive transformation. It's about legacy meeting disruption, tradition meeting technology, and ambition meeting reality. TATA Motors' commitment to JLR remains strong, but realism is beginning to temper optimism. The next 5 years will determine whether this partnership can weather the storm or become a cautionary tale of overreach. To win, TATA must empower JLR with autonomy, resources, and a clear innovation roadmap. Jaguar, in particular, needs a brand resurrection, bold, uncompromising, and future-proof. Whether it takes the shape of a sleek electric sports car or a revolutionary AI-enabled luxury sedan, the next Jaguar must make a statement. And Land Rover must continue evolving without losing the rugged charm that defines it. In conclusion, the TATA JLR saga is far from over. It's a story of bold bets, painful lessons, and unrelenting hope. The global automotive market waits to see if Jaguar Land Rover can rise from its current crossroads and redefine luxury in the electric era. For TATA Motors, success here will not just be a business win, it will be a legacy-defining achievement. At Drive Studio Updater United States, we'll continue tracking every twist and turn of this fascinating journey.